If you own a home, this may be the most uncomfortable report you watch this year. Not because something has already collapsed, but because of what is quietly changing underneath everything you think is stable. By 2026, as many as 40 million homeowners could lose everything, not in a dramatic crash, not with one single breaking news headline, but in the slow, silent way systems fail when the numbers stop working and nobody wants to say it out loud. And that's what makes this different. When people picture a housing collapse, they imagine panic. They imagine for sale signs everywhere, a sudden drop in prices, banks failing on TV. But what if this time the crisis doesn't arrive like an explosion? What if it arrives like a leak that starts small, a leak you can ignore for a few months, a leak that doesn't look like disaster until the day you realize it never stopped, and now the damage is permanent? Right now, millions of homeowners still feel safe because they're looking at the wrong signal. They're looking at the price of the house. They're looking at the Zestimate. They're looking at that one neighbor who sold for a record amount. They're watching headlines about the market cooling or stabilizing. But the real danger isn't the value of the home. The real danger is whether the home is still carryable, because people don't lose houses first. They lose the ability to keep up with what comes with the house. The monthly payment, the taxes, the insurance, the maintenance, the hidden costs that don't make headlines but absolutely destroy budgets. And here's the key point most reports never say clearly. You can own a home that's worth more than ever and still be closer to losing it than you've ever been. In the last few years, housing didn't just get expensive. The entire cost structure of being a homeowner changed, quietly, piece by piece, and almost every piece moved in the same direction. Up, payments, taxes, insurance, repairs, borrowing costs, even basic services tied to property ownership. The system didn't break, it tightened. And when a system tightens, you don't see mass collapse immediately. You see something more subtle. You see pressure show up as late fees. You see people missing one payment, then catching up, then missing again. You see families cutting everything else to protect the house until there's nothing left to cut. That's why this report matters. Because if you wait until it looks obvious, you're late. Now, before we go deeper, let me be clear about what this is and what it isn't. This is not a claim that every homeowner is doomed. This is not a prediction that the market will crash overnight. And this isn't a replay of 2008. In 2008, people knew something was wrong. You could feel it, you could see it. This time, many people still think we're in a normal cycle. They think it's just inflation, just rates, just a temporary wave. But what if it isn't temporary? What if the next housing crisis is not about prices falling, but about ownership becoming unaffordable even while prices remain high? That's the shift most people aren't ready for, because it creates a different kind of loss, not a dramatic crash loss, a slow loss. And it starts with a simple truth. The home is not the risk, the payment is. In the next minutes, I'm going to break down exactly where the 40 million number comes from, why the year 2026 matters so much, and why so many people who believe they're safe could end up trapped in a situation where they can't refinance, can't sell without taking a hit, and can't hold on without sacrificing everything else. But first, you need to understand the foundation of this entire story. The problem isn't housing. The problem is the cost of carrying housing in a world where the rules changed, where the 40 million homeowners number comes from. When you hear a number like 40 million homeowners, the natural reaction is skepticism. It sounds exaggerated, it sounds like a headline designed to scare, and that reaction is understandable. Big numbers without explanation are meaningless. So let's slow this down. This number doesn't come from one single report or one dramatic forecast. It comes from layering multiple realities that are already happening across the housing system, and then asking a simple question: how many homeowners are exposed if conditions don't reverse? First, look at how many mortgages were originated in the last 5 to 7 years. This includes purchases, refinances, and restructurings that locked people into terms that only worked under very specific conditions: low interest rates, stable insurance costs, predictable taxes, and easy access to refinancing. Those conditions no longer exist. A massive portion of homeowners today are not sitting on 30-year fixed mortgages from decades ago. They are sitting on loans that were adjusted, refinanced, or taken out when money was cheap and risk felt distant. Many of them were encouraged to optimize, to pull equity, to consolidate debt, to use the house as a financial tool. That worked, until it didn't. Now add the second layer: adjustable rate and semi-adjustable mortgages. These loans don't always reset overnight. Some reset in stages, some have delayed impacts, some look harmless for years and then suddenly reprice when a trigger date is reached. Those trigger dates cluster, they don't spread evenly across time, and a significant portion of them point directly toward the 2025-2026 window. Next layer, refinancing dependency. Millions of homeowners were never meant to stay in their current loans long term. Their plan depended on refinancing, on rolling the loan forward, on resetting the payment before pressure became unbearable. That option is now largely gone. Refinancing at today's rates doesn't reduce payments, it increases them, in many cases dramatically. So homeowners are stuck in loans that were designed to be temporary, but are now permanent. Now add taxes and insurance. Property taxes don't care about interest rates. Insurance companies don't care about affordability. They price based on risk, replacement cost, and exposure. And across large parts of the country, those costs have surged, not once, not temporarily, but year after year. So when you stack these factors together, you're not looking at people who will lose their homes tomorrow. You're looking at people who are structurally exposed, people whose budgets only worked in a world that no longer exists. And when analysts talk about 40 million homeowners, they're not saying all of them will lose their homes. They're saying that tens of millions are one shock away, one job loss, one medical event, one tax increase, one insurance jump, one payment reset. That's the difference between stability and fragility. In 2008, the danger was obvious leverage and speculation. This time, the danger is normalized fragility. Ordinary households stretched across multiple rising costs with no easy exit. And that's why this number keeps coming up in serious conversations behind closed doors, not as a prediction of collapse, but as a measure of exposure. Because when a system has that many exposed participants, it doesn't need a trigger event. Pressure alone does the work. And that brings us to the next layer of this story, the part that most people still underestimate, the assumption that interest rates will come down in time to save the situation. That assumption is the most dangerous one of all. For years, homeowners were told the same thing. This is temporary. Rates would come down, conditions would normalize. Anyone feeling pressure just needed to wait a little longer. Waiting became the strategy, and for a while it felt reasonable. Central banks had reversed course before. Inflation spikes had cooled in the past. Every downturn in the modern era had been followed by easier money. People weren't irrational for believing it would happen again. But this time, something changed. Cheap money didn't just pause, it ended. Not with an announcement, not with a dramatic declaration, but with a structural shift that quietly made low rates incompatible with the rest of the system. Inflation, debt levels, government financing needs, and global capital flows all moved in a direction that made a fast return to cheap borrowing unrealistic. That matters because the housing system was rebuilt around the assumption that cheap money would always be available when needed. Millions of homeowners didn't choose their loans because they were perfect long-term fits. They chose them because refinancing was always supposed to be there as an escape valve. When payments became uncomfortable, you refinanced. When rates dropped, you reset. When equity built up, you restructured. That entire playbook stopped working. As rates stayed high, the cost of waiting increased every month. Insurance premiums rose, property taxes adjusted upward, maintenance costs climbed, but the payments stayed locked and increasingly mismatched to income. What made this even worse was the psychological effect. People delayed action because they believed relief was just around the corner. They didn't sell when they could. They didn't downsize, they didn't restructure while terms were still flexible, they waited, and waiting quietly converted a manageable situation into a trap. Today, refinancing doesn't offer relief for most homeowners, it offers pain. Payments go up, not down, cash flow gets tighter, not easier. What used to be a solution has become a risk, and that creates a new kind of pressure. Homeowners start making trade-offs they never planned to make. They cut savings, they cut retirement contributions, they delay medical care, they carry balances they once avoided, all to protect the house. At first it feels responsible, like sacrifice in service of stability. But over time it becomes unsustainable because the house isn't just a payment, it's a system of costs that moves together, and when money isn't cheap anymore, that system stops bending. It starts breaking. This is why the phrase high rates doesn't fully capture what's happening. The real issue isn't that rates are high, it's that the option to escape high rates is gone. Homeowners are no longer waiting for rates to fall. They're waiting for time to pass without something else going wrong. And time is not neutral. Time adds costs. Time adds pressure. Time removes options. And that leads directly into the next illusion that keeps people feeling safe longer than they should. The belief that rising home values will protect them. That equity, on paper, equals security in real life. It doesn't. One of the strongest beliefs keeping homeowners calm right now is this idea. Even if things get tight, I have equity. On paper, that belief looks reasonable. Home values are still elevated. In many areas, they're near record highs. Owners open their apps and see a number that suggests wealth, safety, and margin. But equity is not cash. And more importantly, equity is not control. Equity only matters if you can access it on favorable terms, at the moment you need it most. And that's exactly when access disappears. Banks don't extend credit when risk rises. They pull back, they tighten requirements, they reassess values conservatively, and they do it all at the same time, across the system. What looked like available equity 6 months ago quietly becomes unavailable right when pressure peaks. This is where the illusion breaks. Homeowners assume that if things get uncomfortable, they can tap into their home, take out a line of credit, refinance, sell quickly if needed, but those options depend on timing, liquidity, and market conditions that rarely cooperate during stress. Selling a home under pressure is not the same as selling a home in theory. You don't control the market when everyone else is trying to do the same thing. You don't control closing timelines. You don't control inspection outcomes, and you don't control how much of your equity disappears into transaction costs, taxes, and price adjustments. And while homeowners are focused on value, the costs tied to ownership continue to rise independently. Property taxes don't wait for relief. They adjust based on assessments and municipal needs. Insurance companies reprice based on risk and replacement cost, not affordability. In some regions, premiums have doubled in just a few years. In others, coverage has become harder to get at any price. Maintenance doesn't care about equity either. Roofs fail, foundations shift, systems age, and those costs hit when cash flow is already strained. This creates a dangerous mismatch. People feel wealthy because of a number on a screen, but they're operating with shrinking monthly flexibility, they're asset rich and cash poor, and the system increasingly punishes that position. In past cycles, equity growth often masked financial stress. Homeowners could borrow their way through tight periods. Today, borrowing against equity often means locking in higher rates, stricter terms, and long-term obligations that deepen the problem instead of solving it. So equity becomes a mirage. It looks like safety from a distance. But when you reach for it, it's either unavailable or comes at a cost that accelerates the loss you were trying to avoid. This is how homeowners end up trapped. They can't sell without giving up years of accumulated value. They can't refinance without increasing payments. They can't borrow without tightening the noose. And the longer they wait, the fewer clean exits remain. That's why this situation doesn't resolve quickly. People don't panic and leave. They hold on. They stretch. They exhaust alternatives. They protect the house at the expense of everything else. Which brings us to the part of the system that most people never see. The phase where ownership quietly shifts from being a source of stability to becoming a mechanism of extraction. Most people believe that when homeowners start struggling, banks move quickly to take the house. That belief comes from past crises where foreclosure was visible, fast, and dramatic, but that's not how the system works now. Today, foreclosure is often the last step, not the first. What happens before it is quieter, slower, and far more profitable. When a homeowner begins to fall behind, the system doesn't collapse. It tightens, late fees appear, penalties stack, interest accrues on unpaid balances, escrow shortages are recalculated, payments are adjusted upward to catch up. Each step looks administrative, almost harmless on its own, but together they create a treadmill. Homeowners are encouraged to stay, to negotiate, to enter temporary arrangements, forbearance, modified payment plans, short-term relief that stretches the problem instead of resolving it. And while this is happening, the cost of carrying the home increases. This is what turns a financial struggle into an extraction model. The homeowner remains responsible for the property, responsible for maintenance, responsible for taxes, responsible for insurance, but the margin disappears. Every payment covers less principal and more fees. From the outside, it looks like stability. The house is still occupied. There's no auction sign, no eviction notice. But inside the finances, the balance sheet is deteriorating month by month. Banks understand this math. They don't rush to take properties in a tight market. They let the system do the work. They collect fees. They collect interest. They let time erode the homeowner's position. And the longer this phase lasts, the worse the eventual outcome becomes. By the time foreclosure becomes unavoidable, much of the homeowner's equity has already been consumed. Not by falling prices alone, but by years of financial friction, fees, penalties, carrying costs, forced adjustments. This is why many people are shocked when they finally exit. They expected to walk away with something. They expected their equity to protect them. Instead, they discover that most of it vanished long before the house changed hands. And this process doesn't require a crash. It doesn't require mass panic. It thrives in slow conditions, in markets that are cooling instead of collapsing, in environments where people still believe holding on is the responsible choice. That's what makes it dangerous, because extraction doesn't feel like failure. It feels like endurance, like sacrifice, like doing the right thing under pressure until there's nothing left to give. And this is where timing becomes critical, because this entire structure relies on one assumption, that pressure continues long enough for the system to reset ownership quietly, which is why the year 2026 matters so much. When people hear a specific year attached to a warning, the instinct is to dismiss it. Dates feel artificial, like guesswork, like someone picked a number to make the story sound urgent. But 2026 isn't a guess, it's a convergence. Across the housing system, multiple timelines that were set years ago begin to collide in the same narrow window. Contracts written in a low-rate world reach their reset points. Temporary arrangements expire, grace periods end, and the margin homeowners have been living on quietly disappears. Many loans originated or restructured between 2020 and 2022 were built with assumptions that no longer hold. Not just about rates, but about costs staying manageable and access to credit remaining open. Those assumptions were never written into the contracts. They were implied by the environment. Now the environment has changed, but the contracts haven't. By 2026, a large number of homeowners face moments where their situation must be recalculated. Payments adjust, escrow accounts are rebalanced after years of underestimation, Insurance premiums reflect multiple cycles of repricing. Property taxes catch up to assessed values that were delayed or capped temporarily. None of this happens all at once. It happens account by account, household by household, but the timing clusters. At the same time, many of the financial buffers people relied on are thinner. Savings were drawn down during inflation, credit cards absorbed shortfalls, retirement contributions were paused. What looked like resilience was often just deferred damage. By 2026, that damage becomes visible. And here's the key point. By the time a homeowner reaches this moment, the system offers fewer exits. Selling under pressure means accepting worse terms. Refinancing means locking in higher long-term costs. Borrowing against equity means compounding risk instead of reducing it. So the decision isn't whether to act, it's which loss to accept. This is why analysts pay attention to dates like this, not because something magical happens in a calendar year, but because contracts and costs don't negotiate with hope. They execute. And once those executions begin, they don't reverse easily. Which leads to the final uncomfortable question in this story. Who is most exposed when the margin finally runs out? Because it's not always who people expect. When people imagine a housing crisis, they usually picture the same profiles: speculators, over-leveraged investors, people who bought too much house with too little income. The narrative feels comforting because it creates distance. That's not me. But this cycle doesn't start there. In this environment, the first to feel real pressure are often the ones who did everything right. The people who bought one home, not three, who paid on time, who avoided unnecessary risk, who treated ownership as stability, not speculation. These homeowners tend to share a few traits. They're disciplined, they prioritize their obligations, they protect their credit, and because of that, they stretch longer than they should. They absorb pressure quietly instead of triggering alarms early. They don't miss payments at first. They adjust. They cut discretionary spending, they delay upgrades, they sacrifice personal goals to keep the house stable. From the outside, nothing looks wrong, but internally, the margin is gone. Retirees are especially exposed. Fixed incomes don't adjust upward when costs do. Insurance increases hit them harder. Property tax adjustments compound over time. And selling often means giving up proximity to family, healthcare, or community. Middle-income households face a different trap. Their incomes are too high for assistance, but not high enough to absorb repeated cost increases. They're expected to manage indefinitely, even as the system removes flexibility. And then there are families with strong credit but limited liquidity. They qualify for everything on paper, yet struggle month to month. Their discipline keeps them afloat, but also keeps them inside the system longer, where extraction quietly accelerates. This is what makes this cycle different. It doesn't punish recklessness first, it punishes endurance. The people who leave early, who downsize before pressure peaks, often preserve more of their position. The people who stay and push through tend to lose more, slowly. And that creates a psychological trap. Homeowners associate staying with responsibility and leaving with failure, but in a system designed around extraction, staying is often the most expensive option. By the time this becomes visible in public data, the damage is already done at the household level. Which brings us to the final piece of this story, the part that most people still misunderstand. Because what's coming doesn't need to look like a crisis to be devastating. By the time most people agree that something is wrong, the losses will already be locked in. That's the uncomfortable truth about this cycle. It doesn't rely on panic. It doesn't need a crash. It works because it unfolds slowly inside contracts, payments, and obligations that don't make headlines. What's coming doesn't look like 2008. There won't be sudden chaos in the streets or mass foreclosures overnight. Instead, there will be quiet adjustments, rising balances, shrinking options, households carrying more risk with less flexibility month after month. And that's why so many homeowners will be caught off guard. They were waiting for a signal that never arrived, waiting for rates to fall, waiting for relief, waiting for confirmation that the worst was over. But systems don't wait. They execute what was written years earlier under assumptions that no longer apply. And once that execution begins, reversing it becomes nearly impossible without absorbing a loss. By 2026, the question for many homeowners won't be whether the market recovered. It will be whether they still had enough margin to stay inside it. This is not a warning meant to create fear. It's a warning meant to create awareness. Because the most dangerous phase of any financial cycle is the one where everything still looks normal. Silence is not stability, it's just the phase before consequences.